Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Poniotu, certified financial planning professional, the Cap and Capitalize. And on today's episode, we're going to mix it up a little bit. And this is going to be the first of a couple types of this episode that we're going to sprinkle out throughout the year 2025. I'm going to be answering some of your questions that you have DM'd me, whether it's on social media or directly to my email. Now, before we do that, I need to give you the free financial tip of the day. In this case, it's financial. Concentrate on an investment strategy that you understand, but be prepared to evolve as your wealth grows. So I'm just going to use myself for a second. I was a stock guy until... And like only a stock guy when it comes to long-term wealth until probably 2015, 16 for sure, where I started to discover the value and the usage of alternative investments, and mainly it was real estate. And then I started understanding more of the real estate side of things. And then that led into private equity, that led into business development companies, which are lending strategies, so on and so forth. But I stuck to my core principles for a very, very long time until kind of by default, there was no other way around it. I had to go and keep building my blocks on top of my core framework. And I say this because a lot of you out there get really excited about the next shiny object. There is a ton of wealth behind the sentence, keep things as simple as possible and as boring as possible. So keep concentrating on what you know, and over time, you're naturally going to learn more. So now that we got the free advice out of the way, I want to go over 3 of my fans or friends' questions. And we're just going to jump right into this one. And the first one was asked by Chris Butler. He asked me, quote, quick take, if you had $200,000 to invest right now, would you put it into a stock or a mutual fund strategy? That's not as simple of an answer as you're probably looking for, but lucky for you, I'm going to give you everything that you need to know. The first part of that is it comes down to your temperament and understanding. I'm not going to say that there's anything wrong with a stock portfolio. I'm not going to say that there's anything wrong with a mutual fund portfolio. And I'm not going to say there's anything wrong with an ETF, or commonly known as an index fund portfolio. It's kind of different strokes for different folks. The way I like to explain it to people is that's like saying, well, I'm more of a vanilla ice cream guy. Maybe my brother's more of a chocolate chocolate ice cream guy. Maybe my teammate is an assistant is a strawberry ice cream fan, but we're all in Baskin and Robbins together. It's kind of the same thing when you're talking about the stock market. Now, one thing that you need to think about is, where is this money? So if you have money, and this $200,000 that you're talking about, Chris, is in your retirement plan. From a tax standpoint, doesn't really matter what type of strategy you choose, because until you pull that money out, if it's an IRA, it's going to be taxed at ordinary income. And if it's a Roth IRA or Roth 401k, it's going to be considered tax-free. But if it's a taxable account, this is where it gets a little bit more complex and a little bit more squirrely. And I actually learned this when I was at one of the largest firms in the world when I started in this business. So I actually saw clients, and you also got to go back a little bit. This was during 2008. What a time. So I saw people in their portfolios, they would come in to the office and they would have a massive loss because it was the Great Recession. That in and of itself wasn't peculiar, but what was really odd was some of these people had significant capital gains on their portfolio. I'm like, how in the world is that making any sense? And so when I dug in a little deeper, and this actually took me a couple of years to figure it out, when you own a mutual fund, who's the client? You're technically not the client. The fund is the client. And the mutual fund money manager, his or her duty is to make sure that that fund is invested as optimally as possible. So a lot of these tax consequences flow to you, the owner. Well, if you have a taxable account, and especially some of the people we were working with at this huge wealth management firm, they were in the highest tax bracket. They had not only a 50% loss on their money, but they're paying a 25% long-term capital gain on top of that loss because the fund maybe is selling a individual investment or investments within the fund, and they flow the tax consequences to the investor. That sucks. So for that specific reason, I would say that a stock portfolio, if you had to pick between one or the other, would probably be your best bet. Now, you also asked this specifically for me, and I can tell you, so my 401k is invested in a series of mutual funds. I'm not going to tell you the company just for compliance purposes. And I can tell you within my wife and my Roth IRA, we actually have individual stocks because that's the world I know and understand. And even in our taxable account, we do have individual stocks, and there's a couple reasons why. Number one, when you invest in a mutual fund, you can't truly control what you own. Excuse me. You can only control the ownership of the fund, but the money manager that's managing the fund is actually controlling the portfolio. And a lot of these mutual funds have hundreds, if not sometimes thousands of different stocks. And so because of that, if you have a gain in the mutual fund, like let's say you have a stock in there and it's up 100%, which would just be huge. You're not even going to notice it. You're not going to feel it. And frankly, you should be rewarded for your right picks. Now, a lot of people will go and say, well, but what if you're wrong? That's where obviously diversification is important. But diversification, what is conventionally known as diversification, I should say, is so heavily leaned upon. The real translation of diversification in meaning is it's for those that don't know what they're doing. Because if you see a couple really good companies and you understand them like the back of your hand, are you taking any risk in investing in only a few companies? I don't know. I'm going to let you decide that, because if I make a decision on that, compliance is probably going to slap me in the face, and I don't want that. So that is how I personally would do it. I just happen to be more of a stock investor if I had to pick the two that you mentioned, but you're not going to get hurt either way. It just comes down to your temperament. And that's something we talk about a lot. That's something I wrote about extensively in my book, Behavioral Finance. You need to understand qualifiably and quantitatively who you are. And then within your plan, once you actually align your plan, then you open up every part of your plan, every box, if you will, if we're keeping in line with my book. And at that point, you can select which vehicles within that box work best for you. Because even though I might be a stock guy, you might be a mutual fund guy, hypothetically, it's still within your stock market allocation. And therefore the plan still works, but then we just have a different behavioral temperament. So it's a great question, but it was not an easy, just quick answer. Which brings me to the second question. And this is from my good friend, Rena Friedman Watts. Howdy, Rena. Chris, if you had $300,000 to invest, how would you turn it into $1 million the fastest and with the least amount of risk? I probably read that a little bit broken, but this was the question verbatim. So if I had $300,000, how would I turn it into $1 million in the fastest way possible while also taking the least risk? So part of this is you're kind of asking to have your cake and eat it too. And one of the things that I have to remind you and everyone listening in is there is no such thing as a quick dollar. Occasionally, you can be rewarded prematurely. So let's say that you invest in a stock, and we've actually had this happen rather recently where we bought a company. Let's say it was, I don't know, in the mid-teens, and in 1 year it jumped to almost $40. Excuse me, in 10 months. That we did not expect. We expected it to be a really good company, expected it to grow over the long haul. But sometimes your long haul is gifted to you prematurely, so you should be a steward of that gift. And sometimes that means you need to move on altogether, lock in the gain, and call it a night. But back to your point, how would I turn $1 million, a 300,000 into $1 million fastest with the least amount of risk? It's actually not an investment answer. It is a you and your business answer. So what is the best way that you can guarantee a return? And I know compliance hates it when I say this. Frankly, by investing in yourself. And that's not like a motivational Tony Robbins type of quote. There's actually quantifiable backing behind that. So let's say that you're listening in and you do have $300,000 to invest and you run a business. And we'll get to if you don't run a business in a second. But let's say you run a business and you go, okay, I have $300,000 and I am going to go and invest that into marketing. And so $300,000 goes away. And then you calculate, okay, when am I going to get that money back? Let's say that you get that money back in 3 years. That is a 33% return on your investment. And what's also really cool about that is not only do you get your $300,000 back in 3 years, even after that point, if you keep going with that trajectory, it's all just free cash flow. And you're going to hit that million really, really quickly. If it took you 4 years, there's 25%. If it's 5 years, you're going to earn 20% on your money. And the reason why I'm saying this is, 33 or 25 or 20%. Is that a lot more than 8? And the reason why I say 8, for those of you that are new to the show, is we know that since 1950, there's never been a 15-year period where the market has not gone positive, and there's never been a 25-year period where the market has done a bare minimum of 7.94%, but let's round up to 8. I say that because there is no way that you could, quote unquote, guarantee that type of return, like a 33 or 20 type of percent return in a short period of time within the market. But if you do understand your business and you understand how to reinvest within your business, that is going to be the best way. And I can actually argue that's the least risky route because you know your business like the back of your hand. Now, if you don't run a business, it's actually a little bit more simple. Let's say that you don't run a business, but you want to start a business. You work backwards. You have $300,000 to invest. You say, okay, how fast can I actually earn a positive profit on my investment? And frankly, that $300,000 will turn into $1 million very, very quickly. You could also, if you don't want to run a business, but you work for a company, and let's say there are ways that you can go and reinvest into yourself to earn a better return on yourself in your craft. That's another great route to go. But a lot of people think that, $300,000 to invest, turn it into $1 million the fastest and with the least amount of risk. They immediately go to the investment world. Frankly, the easiest answer is right in front of your mirror. You just got to look yourself in the mirror and tell yourself, what can I do? Because you're going to be better than any investment that you invest in. Now, if that answer is not good enough for you and you are asking from an investment side of things, compliance is not going to like this, but I'm going to say it anyway. And I'm going to try to be as compliantly appropriate as possible because they are very sensitive in the world of compliance. So anytime you own debt in a business, in theory, you're not going to earn as much as actually owning the business and getting the upside. So you're probably going to want to look into having ownership within a business. A lot of people like to look into real estate, and they have been blinded by the real estate boom that has happened for the last couple of years. By last couple of years, I could say 2013, 2012, 13 after the Great Recession, up until recently, 2022, 2023 for sure. The average business will outproduce, as far as revenue, the average piece of real estate. And actually, you don't have to take my word for it. You can take my good buddy Adam Cecil, who wrote Where the Money Is. He's been on my show. Love the guy to death. And he actually has a chart on what the average piece of real estate, in this case, single family or multifamily real estate investments, what the growth rate was and what the average successful business's growth rate was. And I believe the number was 4 versus 15%. But then it also makes sense if you think about it, because for real estate, you can only control it so much. If you buy a really nice home, but it's just in a dumpy neighborhood, you're going to have a rather dumpy price if you try to sell it. And if you buy, let's say, just a honey bucket of a home, but you're in Beverly Hills, naturally, that's going to be a pretty pricey honey bucket. And my point is, you can't really control the investment. With a business, you can control your destiny to the nth degree. So how would you turn the million, turn into a million the fastest and with the least amount of risk? Frankly, you got to get really creative. If you invest in small businesses, there's a ton of risk there, in theory. If you invest in larger businesses, there is business risk. Don't get it twisted. But frankly, larger businesses, they have enough of a moat where the odds of them getting hurt as opposed to a small business is a lot less. And if you can find a large business that is just selling at a fat discount, or a couple of them, that from an investment standpoint is probably the fastest way for you to turn that $300,000 into $1 million in the fastest amount of time possible, while taking the quote unquote least risk. Now, before we answer the last question by my buddy Jonathan Cohen, we are going to take a quick commercial break. Stick around. I will see you momentarily.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back to the episode. We are going to get right back into things with the final question from my good buddy, Jonathan Cohen. And this is he kind of got away with asking like 3 questions in one, but because he's a friend, of course, I'm going to answer all of them. But it is a multi-parter. So John, you asked, how do you help people to think longer term? Long term is 7 years out for tons of people. Yet you consider this short term in your book and framework. How do you help people see a better life in 7 years through that lens? Whew, what a phenomenal question. So how do you think longer term? Well, part of it is, unfortunately, kind of how you're wired. Some people simply cannot conceptualize thinking anything past 1 to 3 years. They just can't. Now, what you also can do to mitigate that is you can go back and understand the research, and you can understand the methods to the madness of actually compounding into financial success. But you also have to develop almost a level of stoicism. And I don't really think I would identify myself as a stoic, but in a lot of ways, you have to block out the noise and just look at what you own and look at your trajectory. So when you said long-term is 7 years out for tons of people, yet you consider this short-term in your book and framework. So think about whatever you're doing in life. And I'm talking about your career. Now, I'm not saying you have to stick at the same place forever, but the average career is going to last about 30 years for people, maybe even longer, 30 to 40 years, depending on, if it took a couple of years to get going or you just jumped right into what you were born to do. Well, 7 years is a fraction of that time. And then if you apply that mentality and framework and align it with the investment side of things, that is a really easy hack for you to align yourself mentally in accordance with your plan. You can even go a step further with that. Let's say you do run a business, or you're an executive, or you're climbing the corporate ladder, or you work at a small company and you are just steadily improving yourself. You're not going to quit. Obviously, if like something drastic happened or you're in a miserable spot and you want to leave your job, like I totally get that, okay? But let's assume that you're in a really good place, really good spot. And sure, there are bad days and days that are better than others, but all in all, you're doing well and you see the long-term time horizon with what you're doing. We're not just going to quit because you have one tough day or two, or maybe even a month. You're not going to. You're going to figure it out. And also, that sometimes you have a really, really tough time, but that is a gateway to a ton of positivity that is coming down the pike for you. It's the same thing when you actually understand what you're owning when it comes to your plan. Now, if you're a stock portfolio type of guy or gal, it's probably a little bit easier for you to understand this because you understand the businesses that you own. And just because they have a bad quarter or they have a bad year, because maybe something out of their control happened, that doesn't mean you're just going to get out of it. Now, there are times where it makes sense to move on, but when you go into investing into businesses, you have to think in 10-year increments at a minimum. At a minimum. I've talked about this in the past, but I got to bring it up again. Famous investors like Warren Buffett. Warren Buffett, his holding time frame is forever, ideally. I've actually talked to a number of my buddies in the investment world, two in particular, Kyle Grieve and Sean O'Malley of the Investors Podcast Network. And we talked about this ad nauseum, how short the average time span is for someone holding an individual stock. I think in the 70s and 80s, the average time horizon for holding a company was about 5 years. And now it's 10 months. That's insane. You can't just dip in and out and in and out. You've got to understand what is going on with the business, and you have to apply it with an ownership mindset. And that is no different than thinking long-term. You have to think about it as you are owning your time. You're not just dipping in and out or gambling with it. Now, as far as seeing a better life in 7 years through that lens. So if you're listening into this and you're just getting started in work, it's going to be a lot harder because just by definition, you don't have as much time on earth as someone in their 30s, 40s, 50s, et cetera. But let's say you're in your 30s and you do have a little bit of life experience and you know 7 years goes by like that. I would say that the longer you progress through life, you realize how fast 7 years actually is. And you realize too, that if you're going to be successful in something, it's going to take at least a couple of years to get going. In my second book, Capitalize Your Sales, I wrote about this. It takes about 3 years to get your business or your sales and your reputation to be up and running in the right direction. The first year you become known, the second year you become trusted, the third year you start to get referrals from the first year, and then it starts to take off and compound. And that's really minute because that's just you. If you go and you own or you run a very large business, it is going to take a heck of a lot longer to get all of that, frankly, junk ironed out in the business. And then once all that's ironed out, you see a nice little trajectory. So when you're thinking about, okay, what is it going to look like in the next 7 years? One of the easiest tools that I use for myself is I look back 7 years ago, and this recording is at the end of 2024, beginning of 2025. And I think to myself, okay, so I'm 33. What was life like when I was 26? Well, the business almost went under. It was paycheck to paycheck. I was in my apartment. I frankly did not have a lot of hope other than my faith. And yes, things were starting to tick up, but just barely. And I was hanging by a thread. I think about how fast that went. And then I also think how better off, and I'm thankful for this, my wife and my family and I are at this point versus 7 years ago. It gets me really fired up about what the next 7 years are going to look like for me. Because if it keeps compounding up and to the right, not just with a portfolio, but just in the positivity of life, you latch onto that and you kind of become addicted to it. And sure, you might have a couple years where it is rough. Maybe some of you listening in are going through the loss of a loved one, or you lost your job, or you got a pay cut, or something came up and you weren't ready for it financially. I can tell you right now, and obviously like other than the loss of a loved one, because there's other than time, and I don't want to say time heals all wounds because it doesn't totally do that, but you learn to deal with it more. But all those other bumps in the road, that is just leading you to something that is so immensely positive, you simply can't comprehend it. So I know that went on a little tangent when it comes to how do you help people see a better life in 7 years through that lens, but it's immensely valuable nonetheless. The last thing I want to actually say on this too. So if I'm actually like writing a plan, and I think about this from someone that is in their 30s or 40s, or I could even say 50s, because up until you're probably 10, for sure 5 years out from retirement, those plans are actually going to look very similar. You're just trying to grow until you actually retire. And I say that because when you actually look at the process and you look at your plan and you look at 7 years down the road and it's compounding at whatever that return is that your planner is put into your plan, whether it's 6, 7, 8%, it doesn't matter. Something long-term related that's appropriate. Could you earn a little bit more? Sure. Could you earn a little bit less? Yes. However, you know that even though there's that variability within that window, you got to keep going and you've got to stick to your process, because in 7 years, regardless of where you're at up here, you're way better than when you're starting, which is today. So there's a number of different tricks and tools at your fingertips with this, but it's a lot more psychological, and there's a smidget of it where it's your wiring. That is what it is, okay? And unfortunately, you can't really control that, but you can train yourself and coach yourself relentlessly to have a better mindset with that. So hopefully that answers your question, Jonathan. That was a fantastic one. And frankly, I could go an entire episode answering that one alone. But my marketing team has given me the go away motion. So unfortunately, that means we are all out of time. But as always, I'm your host, Christopher A. Panayiotou, the Cap and Capitalize. And until next time, keep capitalizing. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher Panayiotou, Certified Financial Planning Professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. Alternative investments may not be suitable for all investors and should be considered as an investment for the risk capital portion of the investor's portfolio. The strategies employed in the management of alternative investments may accelerate the velocity of potential losses. Investments in non-traded business development companies are subject to significant risks. If you're able to redeem shares, they will generally be redeemed for less than the original amount invested. Investing in these products may not be suitable for all investors. You should carefully consider the investment objectives, risks, charges, and expenses of a non-traded BDC, mutual fund, or ETF before investing. The prospectus, which contains this and other important information, can be obtained from your financial advisor or the issuer directly. You should read it carefully before investing or sending money. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Distributions of principal from a Roth 401k are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth 401k was established, whichever is longer. Your investment options are limited with a Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. Christopher Panayiotou is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. The people and companies mentioned in this podcast are not affiliated with or endorsed by LPL Financial or Capitalize Your Finances.